It was an interesting day in the stock market. The S&P 500 was actually down about 0.3% today, and much of that is attributable to Apple. Of course, the biggest publicly traded company out there that has the most influence on the S&P 500 was down about 3% here today, with some news stemming from government officials' bans of iPhones over in China. So we'll see if that picks up any steam moving forward here. But it did seem like today the technology was the rare laggard of the market. We also saw weakness within the small cap universe, largely due to some of the banks that were out there. In tonight's video, we're also going to take quite a bit of time and go through a number of the foreign markets out there. There are a ton of foreign markets like Mexico, Germany, the Netherlands, France, Spain, Taiwan. A whole bunch of international markets ended the day with oversold cluster signals, likely due to the ongoing strength in the US dollar. So could be some potential for some reversion to the mean types of moves there. We'll keep our eye on that. And then in tonight's trade application example, I wanted to focus on a technology stock that has been underperforming the S&P 500 for the last 2.5 months. It's bouncing down and away from its falling 30-day moving average here today. So I thought it would be a good example for a bear call spread. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's September 7th, 2023. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into the description area. Make sure you're signed up for our email distribution list, so that way you can be notified whenever we post these videos. Also, keep in mind at the bottom of those emails, you'll find which stocks are giving you overbought and oversold cluster signals within the S&P 500. In addition to that, we're heavy users of X, formerly known as Twitter. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee. And we really appreciate those of you that click like and repost and comment and all that good stuff on that platform. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And as usual, I've got the S&P 500 heat map pulled up here in front of us. And you can see it was a little bit of a split decision type of a day. The market was actually down, I think it was 0.3%, somewhere in there. And it looked a little hairy at the beginning of the session, particularly because of Apple. Some bad news with Apple and getting some of their phones banned by government officials in China. So anyway, it seemed like it was going to be perhaps an aggressive sell-off day when things kicked off trading here this morning. But as the day went along, calmer mindsets prevailed, and you can see we actually had quite a nice helping of green patches out there. So let's see what we can learn. I guess we'll start off with the stock of the day, which is Apple. It still was down about 3%. And of course, Apple is still the largest publicly traded company and therefore has the biggest impact on the S&P 500. So today was a day where your portfolio may have done a bit better than the S&P 500 because, Apple is probably not going to be as big of your portfolio as it is within the S&P 500. For some of you, that may not be the case, but regardless, today was a day where you had a little bit more pressure on some of those prominent areas. Remember, Apple does have a product event here within the next week or so, where they'll probably be unveiling the new iPhone, and we'll see if they can gain any traction before then. But right now, stumbling a little bit, and not really giving the market the support that perhaps it wants. You'll notice that within that technology sector, NVIDIA also was down here today. Some of you have been seeing the stories swirling around on Twitter/X. I posted a couple of jokes about it, but not necessarily anything hard-hitting, but there are some major question marks around one of their key customers called CoreWeave. And, it makes you wonder if there is an opportunity for the bears to kind of take this moment in time and run with it while there's a lot of confusion out there from NVIDIA. Then again, maybe they come out and clarify everything and we're back to the same old uptrend. But without a doubt, NVIDIA has been a superstar stock for much of this year. Has a massive market cap of over $1 trillion right now. And, hopefully the sales and the earnings and everything that they're getting from all of their customers is legitimate. And it's not just being kind of pushed out to kind of fuel this AI theme there. But today, another day where NVIDIA was under pressure by 1.7%. Microsoft was down as well. Wasn't down nearly as much as the other two, but still down 0.89%, so underperformed the overall market. So remember, those are your big three kahunas right now within the technology sector itself. All three of them were down today, so I would imagine that when we get to the point of reviewing our Sector 12 grid a little bit later on, I would imagine that the technology sector was probably today's worst, but we'll find out soon enough. You will notice that there were a handful of other software-related names that did manage to close in the green, like Oracle, Salesforce, Intuit, even Fortinet, and then down below in some of the more consulting area, Accenture was up. So there were a handful of green patches there, even in the tech world. And I should also mention Intel. Look at how small the square for Intel is now. It used to be such a dominant company. Now it's kind of an afterthought compared to NVIDIA. But lowly old Intel had a pretty good day. And they've actually been in a pretty considerable upswing here more recently. They were up 3%, but they basically have no effect on the overall S&P 500 anymore at their current size. In terms of the other sectors outside of technology, things went reasonably well. In the communication services area, Google had a decent day, up 0.61%. Meta did fall a little bit, but it was more of a flattish end of the day for them, down just 0.17. In terms of the other Magnificent Seven companies, the superstar over here in the discretionary world was Amazon today, up about 2%, but Tesla, similar to Meta, did fall 0.17%. So all in all, it was a bit of a mixed day, not just for the market at large, but even within the Magnificent Seven itself. And more times than not, those seven companies tend to kind of move up and down together, but today was not one of those days. You'll also notice that we had some pretty strong performance out of some of those healthcare companies. So some of those areas that have been really out of favor here lately finally caught a bounce today. Take a look at the utilities, by the way. Utilities really started to pop a little bit higher here today after just an epic beatdown that they've been going through for the last several weeks and months. So how long that lasts, anybody's guess, but certainly overdue for some sort of a short-term rally, you'd like to think. But some of those utilities getting a little bit of a relief rally. But again, remember, utilities are a pretty small impact on the overall market. The healthcare companies, which are also defensive to a degree and have also been out of favor here lately, they do have a bigger impact on the market. Remember that today, the world's biggest publicly traded healthcare company is now Eli Lilly, right? For a long time, it was kind of Johnson & Johnson versus United Healthcare. They would go back and forth. But with this huge surge we've seen in Eli Lilly here this year on the back of their weight loss drug, they are now the big fish in that particular sector. And they had a great day. I believe they went back to all-time highs here today, up 2.37%. We are cheering that one on in our top-down trend trading class, as we've held it for over a year at this point and have been able to take advantage of that huge move into that class. We also own Novo Nordisk, which is kind of a European competitor also in that weight loss category there. So anyway, that is one theme that has not yet been derailed. We'll see if it eventually is. Eventually, you would like to think that valuation concerns will set in. But then again, we're talking about potentially a game-changing type of a drug, considering how many folks out there may benefit from losing a few pounds out there. I could be one of those, perhaps. So anyway, we'll see how that goes moving forward. But right now, what we can say is that trend is very much in place still. Johnson & Johnson was up 1% today. United Healthcare was up 1.5%. We had Merck up just over 1%. A lot of the health insurance companies had a nice day. So Humana up 1.5%. Centene was up 5%. That was actually, I believe, the best performing stock in the S&P 500, $35 billion company there. And a number of others that held in there okay. Now, you did still have a few of these healthcare companies that were struggling, especially in kind of the medical devices area. Intuitive Surgical was down over 3% today, so a pretty rough session for it. So it was a little bit more hit and miss there in healthcare. But all in all, I would say, the green squares do outweigh the red ones there. AbbVie and Amgen both had nice days today as well. Off to the right-hand side here, you can see that the consumer staples had a reasonable day. Walmart, Procter & Gamble both had sessions that were up about 1% there, so that helps. We saw a lot of the real estate companies moving higher today. American Tower was up 2.5%. That's a stock that's really been hit pretty hard over the last year or so. So just like the utilities, there's a lot of REITs that are probably overdue for some sort of a bounce. Yes, it's true they have interest rate sensitivity and interest rates keep going up and yada, yada, yada. But at some point, there's got to be value in the underlying business as well. So it'll be interesting to see if we can uncover that value at some point. In terms of the consumer discretionary area, I already mentioned Amazon, but Home Depot and Lowe's both had good days as well. We actually had a good conversation in class today about Home Depot and to a degree Lowe's, and had a nice comparison of that home improvement company versus Verizon, with Verizon announcing a dividend increase earlier today, but kind of went back and looked at kind of a 10-year history of Verizon versus Home Depot and how you would have been far better off investing in Home Depot, even from a pure income perspective, when you start thinking about things like yield on cost, because they've had a much, much more aggressive dividend growth rate, whereas Verizon, you would have started with double the yield at the beginning of that 10-year period, but they grew their dividend so slowly over the years that by about year 6, there was that crossover point where you'd have been much better off in Home Depot. So had an interesting conversation about that earlier today in class. McDonald's was up over 1% today. Some of you might have seen my post on X/Twitter here a moment ago, trying to drum up some conversation about who has the best French fries out there. And it's always a hot topic because, of course, we all have different tastes. But it was interesting to see how many of you voted for McDonald's in that regard. And it's hard to argue. Those nice golden crispy fries fresh out of the fryer, it's hard to pass up. Some of you saw my post last weekend when I was in Sun Valley. We happened to be driving on the highway next to a potato farm, and there was this massive pile of potatoes there. I don't know how tall it would have been, but probably like 30 feet tall, just all potatoes. I had to take a picture of it. So when you're in Idaho, you gotta have that potato culture apparently. But anyway, McDonald's selling all their French fries and up a nice 1% here today as well. Let's talk about some of the losers now. I already mentioned the technology sector as probably being the one that's the most out of favor. But another area that kind of caught my eye was the financials. They didn't seem to have a particularly great day. Yes, it's true that the credit card companies and Berkshire Hathaway, which are, those three companies are kind of quasi-financials. They did all manage to close in the green here today. But your more pure financials like the banks, they had a tough day. JP Morgan was down about 1%, so was Bank of America. Wells Fargo down just a little bit more than 1%. Citigroup down just a little bit more than 1%. So, that has not been a great place to be hanging out here more recently. You also saw that it was a bit hit and miss there within the industrial sector. That's one that, remember, we talked about it on Tuesday as being kind of starting to swing out of favor after having a tremendously strong first half of 2023. It seems like some of those industrials are starting to hit the skids here a little bit. So a lot of those companies like Caterpillar, John Deere, Illinois Tool Works, Rollins was one of the worst performers out there. It was down about 6% here today. So some of those companies really struggled. But I would say that, the takeaway of today's heat map and the market action, it kind of felt like technology was the sector that really struggled. And then it was kind of the interest rate sensitive areas like the utilities and the REITs that had the most consistent bounce backs. And then you had a couple of superstar stocks that just kept on plugging away, like Eli Lilly. By the way, T-Mobile catches my eye here in the middle as well. They had a nice day up over 2%. Some of you might have seen my post here recently on Twitter that they have announced that they are now going to start paying a dividend. Remember, T-Mobile was a little bit odd in the telecom space because they never paid a dividend. They were kind of considered more of a growth telecom, and they vastly outperformed Verizon, AT&T over the years, but they're kind of joining their ranks now by starting to finally pay a dividend in that area. So it looks like the market was somewhat enthusiastic about that news here today. Let's go ahead and take a look at the specific breadth numbers now. Popping on over here to the other part of the platform, you can see that 205 stocks out of the S&P 500 closed higher here today. That's good for about a 41% or 40% hit rate, somewhere in that general vicinity of stocks that were up versus down. So slightly more stocks down today, but it probably was not that big of a deal when you look at the 0.32% decline in the market. We had more of a coin flip feeling towards the winners versus the losers, but the end result for the S&P 500 leaned a little bit more bearishly than you might have assumed looking at those numbers. And again, reason goes back to what I had mentioned before. Apple is the most dominant company in the S&P 500, and since it was one of the worst performers in the S&P 500 today, it's going to have a bigger impact on pushing that index lower than you might have assumed. Some of you might have even had your securities in your portfolio up today on a day when the market was down, and that doesn't happen a whole lot, but usually when it does happen, it's a day when Apple or Microsoft is having a tough session, and that was the case here today. So S&P 500 down 0.32% today. You can see that we have the weekly bearish posture, so not strongly bearish, but weekly bearish at the moment, and that started yesterday. So you can see here that it kind of popped below the moving average yesterday as well. So you'll notice that the moving average color is red. So that's different from the last time I was with you on Tuesday when it was still yellow. So what that means is price is now below a falling 30-day moving average. And you'll notice that is now the case for all four of our charts. So when I was last with you on Tuesday, the S&P 500 and the NASDAQ still had the yellow moving averages. But here we are 2 days later, and there's been more selling pressure. So the signs are starting to get a little bit more bearish here all of the sudden because even the tech sector is having a hard time carrying this whole market here at the moment. So all four of these charts have those red 30-day moving averages with price below falling moving averages, and then all four of the charts also have bearish market forecast postures. In this particular case, you'll notice that the color scheme on the S&P 500 background and the NASDAQ composite background are both that lighter shade of pink, telling us that we would consider that weakly bearish, not strongly bearish. Over here on the right-hand side, a little different story. Dow Jones Industrial Average and Russell 2000, both with that darker shade of pink, telling us that those are considered strongly bearish. So, they're the kind of the ones leading the way to the downside. In terms of actual performance today, once again, it was the Russell 2000 that was the worst performer. Remember, we talked about how aggressive that candle was on Tuesday when I was last with you. Really ugly candle, bouncing down and away from that falling 30-day moving average. Well, the last 2 days have not done anything to settle the concerns in that regard. We've had 2 more sell-off days, and today the Russell 2000 small cap universe down the worst out of all of these. That's kind of saying something on a day like today where Apple was such a big story and technology was really out of favor. Remember, you don't really have a lot of technology exposure within the Russell 2000. So the fact that they underperformed the NASDAQ today is a pretty impactful statement. So the Russell 2000, I think, is probably struggling with what I had mentioned on the heat map, where the banks are really kind of in the toilet here today. So all of a sudden, the Russell 2000 is not all that far away from their 3-month low. So we're going to have to keep our eye on that as we move forward here through September. The Dow Jones, by the way, managed to close in the green today. How about that? Not a lot of people probably would have expected that, but there was enough buoyancy in some of those higher price securities, perhaps like a United Healthcare, that allowed that index to offset the negative impact of a stock like Apple. And then the NASDAQ composite, as I already mentioned, was down 0.89%. So tough day there, underperforming the overall S&P 500 with the pressure in tech stocks. Let's take a look here at our 3 green arrows charts now. And as it stands, we actually don't have 3 green arrows or 3 red arrows on any of these charts. Remember when I was with you on Tuesday, we still had some that were in the 3 green arrow territory, but fast forward 2 more days, none of these have that signal any longer. The main reason is a couple of these charts, like the S&P 500 and the NASDAQ composite, went to red arrows on the 30-day moving average. So although they are retaining their green arrows on the MACD histogram, the red arrows snuck in on those moving averages. And in the case of the S&P 500, we also got a red arrow to sneak in there on the stochastic itself. With the other 2 charts, which we've already known have been weaker, not a whole lot changed since I was last with you on Tuesday, but it is possible those stochastic red arrows snuck in there. But remember, we already had red arrows on the moving averages on those 2 off to the right on Tuesday, so it's not like as big of a surprise here. So the bigger story is losing that support of the 30-day moving average on the S&P 500 and on the NASDAQ. Let's take a look now at our 1040 crossover method. And remember when I was last with you on Tuesday, we were talking about how the Russell 2000 remains the one that, is most likely to have a negative crossover first. And that still is the case. No surprise. Remember, these are longer term charts we're looking at here in this particular case. And so, we'll keep our eye on that story. As of right now, we don't quite have the crossover, but we do have that red arrow above the chart, or above the candle. This is a weekly candle, remember, not daily. So we have a red arrow above this week's candle on the Russell 2000, and we have the red arrow above the candle on the Dow Jones Industrial Average as well. And basically what that means is prices below the 10-week moving average at this moment. So while we haven't had a crossover of the moving averages yet, if we ever are, all of the crossovers have to start with price being below the orange line at some point. Now, that doesn't mean that all the times that price is below the orange line that there will be a crossover. It just means that that will be part of the process if and when a crossover does occur. And if we have more selling going into the fall, as I mentioned before, it's likely to be the Russell 2000 that is the one that kind of leads the way in that regard and moves from a golden cross back to that death cross status once again. So they've kind of been hit and miss this year. Remember, most of these other indices have been largely bullish this year, but the Russell 2000 has kind of been all over the map. Part of that is because of their role, I guess you would say, in the banking crisis here that we suffered through back in March. Remember, a lot of those smaller regional banks are part of that Russell 2000. All right, let's go ahead, pop on over here to the internet. I always like to get a chance to say thank you to those of you that help support these presentations. And you guys did not let me down in that regard this time around, as you guys have been clicking nicely here on that count lately. So thank you to the 105 of you that took the time out of your day to click like for us there. As I always say, as long as we're up and over 100 likes, I'm happy to give you a full-length video. If we're under 100 likes, then we'll try to keep the video nice and short for you, so that way you guys can have some sort of an impact on my videos there. So if you like the longer form videos, take the 5 seconds out of your day to click like. Let's do some shout outs here to see who was willing to support us last time around on Tuesday. Thank you to Fred and to H. Patel and to Dave and to William and Austin and Stephen and John and Terry and Nina and Eugene and Leah and Irene and Arthur and Tamil and Yair and Neil and RZ and Jean and Ash and Randy, Keola, Carl, Monesh, Sandeep, and thank you Sandeep as well. I should mention this. Some of you heard my comment the other day about having multiple instances of the Thinkorswim platform pulled up, because part of my accounts from TD Ameritrade were transferred to Schwab. The other ones remained at TD Ameritrade. And the way that it was working initially is you could only be logged into Thinkorswim on one or the other, but not both at the same time. But Sandeep did send me an article where he found a workaround to that solution, basically creating a new pathway for your desktop icons on Thinkorswim. So if there's any of you that are struggling with that same issue, probably not a whole lot of you, because my situation's a little bit unique with being a teacher, needing to have all those different paper money accounts. But anyway, if you are struggling with that same issue, I did retweet that article that Sandeep sent to my attention there. So thank you again, Sandeep, for that information. It worked like a charm. And thank you to Linda and to Dennis and Oz Trader and Karen and Jayesh and Ryan and Sunita and Janet and Brian and Michael and Edwin and Phil and Judy. Can't get to all of you, but thank you. Really appreciate that. And, hopefully we can get up there towards 100 again for the next video when I'm scheduled to do it again on Tuesday. Earlier today, we had a great day of classes at Market Scholars. David taught his portfolio management class with ETFs, and I taught my question and answer session earlier today. So if you're interested in some additional topics, if you're a premium member, I do have my class recording posted to our Trading Rooms calendar. Today we got a question about reviewing MO or Altria as a dividend growth investing candidate, and also talked a bit about IBM in that conversation and an interesting study that Jeremy Siegel had conducted with one of his popular books here a while back in regards to the performance of those two kind of older school companies over time. We also got a question about Morgan Stanley as a dividend growth investing question. We also got a question about WEC, or the old Wisconsin Energy, and tackling it from a sold put perspective and when we might consider doing some rolls on that type of a trade. We also got a question about looking at stocks that have strong histories of growing their dividends along with percentage increases of the dividends themselves, and did some filtering on the CCC spreadsheet to come up with a nice watch list of companies that in some cases are getting to be very interesting values for the future. As many of you know, the dividend stocks have really been hit hard here compared to a lot of other areas in the market in 2023. So if you're truly long-term oriented, if you're 43 years old and you've got 20 more years in front of you, I think this is an interesting opportunity time to be looking for some high quality businesses to tuck away for future years. So anyway, if any of those topics sound interesting to you and you're a premium member of Market Scholars, you're welcome to listen to that 3.5-hour recording that I did earlier today. Let's also talk about the factor selector while we're over here. So the factor selector, remember, does get produced on Tuesdays, and so it is a couple of days stale at this point here on Thursday. Nonetheless, can give us a general sense as to what rotations are taking place. Of course, we covered this factor selector on Wednesday morning during my factor-based swing trading class, and then discover trade ideas based upon this information as well. So quality is now at the top for the 4th out of the last 5 weeks. And as I mentioned to my class earlier, notice that this orange, ball and line, however you want to describe that, has been either number 1 or number 2 for the entirety of this rolling 3-month graphic that we have here. So quality has not fallen below the second place position for 3 months. That is very persistent strength up there on a relative basis. Remember, quality is driven by a lot of tech stocks. So with a day like today where Apple took it across the chin, we'll just have to see where those companies will be by the time I produce this graphic again next Tuesday. If Apple and Microsoft and those types of companies keep on falling between now and next Tuesday, it's possible that quality would fall back down into the number 2 position. So we'll keep our eye on that possibility, knowing what we now know about the markets. Momentum hung tight there in the number 2 position for the 3rd straight week. Dividend yield managed to stay in the 3rd place position for the 2nd week, but like I mentioned in my class, I get the genuine sense that with these 6 factors, you have 2 true leaders, which are quality and momentum, and then you have 4 laggards that are quite a long ways away from it. So, it's not like these have equidistance between their strength. You kind of have your haves and your have-nots in this market, and the haves find themselves in quality and momentum. The have-nots are those other 4 down below, and they're just all trying to duke it out to see which one is slightly worse than the other one, it feels like to me. So value managed to pop up to number 4. Low volatility rolled back down to number 5 with a lot of those interest rate sensitive stocks. But again, today was a day where the utilities and the REITs fought back. So maybe low volatility will sneak back up in the rankings next week if that theme continues in the short term. And then low size did make its way back to dead last. And based upon what we saw here today, that continues to confirm it, right? So we kind of had opposing forces, what we learned today with quality and low volatility, but basically confirming what we've already known with low size, as the one coach would say, they are who we thought they were, or whatever that phrase is. So anyway, low size is doing what we expected them to do, which is to struggle here at the moment. And that's probably not going to change unless the banks can start stabilizing once again. All right, let's go ahead and pop back on over here to the main part of the platform, and let's do some 12 grid analysis. And so we'll start off with chart 5A here. And you can see that mostly red charts here, or pink charts, telling us that most of these charts in front of us have what's known as bearish intermediate postures using that market forecast technical indicator. We have 3 green charts, but sadly, those 3 green charts are really not helpful for stock investors. And we've talked about the 2 corners endlessly over the last year and a half, and how that presents a bit of a headwind to the advancement of the general stock market. Stock market doesn't like it when interest rates are high because of all the increased borrowing costs for corporations. Stock market traditionally doesn't like it when the US dollar is strong, because we have a lot of, some of the world's best companies here, like a McDonald's and those types of companies that do business all over the globe. So it makes it harder for them to see earnings per share go up when the dollar is strong. They would rather have it the opposite way. And then oil, which doesn't always get lumped in with those 2, but I think it kind of fits the theme right now. Remember, we're in an inflationary environment at the moment, and oil kind of adds fuel to the fire, pardon the pun. But when oil prices are high, it's harder for us to kick out of that inflationary theme, and oil prices have definitely been getting a lot higher as time has gone on, right? We've talked about the difference between gold and oil from a commodity perspective here in recent months, and without a doubt, oil has been a leader and gold has been a laggard, and that continues to be the case. Gold continues to struggle with getting above its falling 30-day moving average, whereas oil continues to bounce up and off of its rising 30-day moving average. So when you've got an environment where the US dollar is strong, oil prices are high, and the treasury yield environment keeps on going higher, that is a very difficult set of circumstances for the general stock market to advance within. So if anything, we would be cheering for those 3 to do the opposite of what we're doing right now if we wanted to see the stock market going higher. So we'll see where that takes us. But if you look at those 3 green charts and you just kind of took out the ticker symbols that you see within the charts, and you just looked at the charts all by themselves, you'd say those are some pretty nice looking trends right there. But the bad news is the nicer that those trends look make it harder for the rest of the trends that most of us really care about within the stock market itself. So without a doubt, we got a few headwinds that we're trying to work our way through here as we go forward here in the fall. So to put a ribbon on it, be aware that the 10-year Treasury yield was down slightly today to 4.26% is where we ended. But of course, we remain in this strong uptrend here. Still have the bullish posture, still above the rising 30-day moving average. Of course, when the yield environment slips a little bit, you assume that bond prices are up a little bit. And that did happen today. TLT, or long-term treasuries, was up 0.28%. BNDX, or foreign bonds, was up 0.25%. And HYG, or high-yield bonds, was up 0.34%. So all three of those bond categories were up today, but you'll notice that none of those three advances were enough to change the posture from bearish, as all three of those charts do remain pink at this particular moment in time. The high yield chart is kind of an interesting one, by the way. That was a nice little bullish engulfing candle that we see there on HYG. It did stop short of crossing back through its falling 30-day moving average. So if you want to be bullish in that area, you'd like to see it kind of get a little bit of oomph there, but not sure if we'll get it or not. We're kind of in the midpoint of what appears to be a sideways channel that we're stuck in with high yield bonds at the moment. So anyway, yes, you got a little snapback there in the bonds, but again, if this is the snapback everybody's waiting for, boy, what a disappointment. This is a whimper, right? The movement probably within utilities and REITs was a little bit better maybe than what we saw here with the bonds themselves. So maybe some of the bond-like proxies could get a little bit more clicking here moving forward. In terms of the US dollar, it was up 0.24% today. It remains with strongly bullish posture, still above that rising 30-day moving average. Remember, when the dollar is strong, we typically find weakness in the foreign stocks, and that was the case today. EFA was down 0.33%, which was worse than the U.S. stock market, and EEM really took it across the chin, down 1.18% today. I'm not sure what accounted for that. My Thursdays are a little bit different, I feel, because I'm in class for so long, for 3.5 hours straight without even standing up, and a lot of times I kind of somehow get unplugged from the market during that time because I'm not a great multitasker. But I have to assume, just looking at the information and knowing what kind of challenged Apple here earlier today, that this was probably China related with EEM here today. But they really got hit pretty hard, down more than 1% today there. And both of those foreign stock categories do have the strongly bearish posture at the moment, whereas the S&P 500 still has just the weekly bearish posture. So it seems like the foreign markets are the leaders to the downside, or if you want to call it another way, the biggest losers or the biggest laggards, however you want to phrase that. But the point is probably being pressured by that ever-increasing US dollar. It's kind of been a pain point for them. Bitcoin did manage to have a bit of a snapback today. Remember, we've kind of been waiting for maybe some movement there because we've had a couple of these little green dots showing up telling us that we've got oversold cluster signals. And so it makes you wonder if they're due for a little bit of a short-term push there. But, be careful with that because, of course, we have to make the assumption that the downtrend will hold until it doesn't. And right now, that 30-day moving average could very well act as resistance if it manages to get back up into that area once again. You're seeing a rollover from that moving average on preferred stocks up above that as just one example. They were down a bit here today as well. All right, let's take a look here at what's been going on from some of the foreign stock markets perspective. We're going to take a look at the global primary 12 grid here. This is chart 5E. Remember, we're assuming that they're going to look worse than the United States, but that may not be the case in every company's or in every country's situation. And if you look at this, first of all, just disregard this Russia one over here. We're all waiting for Russia to start trading again, but with their whole skirmish with Ukraine, it could be years, if any, before we see that once again. But above that kind of blank chart, we have two green charts. We have Japan and we have India. Those have kind of been the standouts, the superstars from a foreign perspective. I mean, heck, you look at India's chart, that looks like a great trend right there in the midst of what is pretty ugly EEM trading in general. That's an impressive move there to offset the weakness of the other emerging markets and just like kind of dancing to your own beat, so to speak there. Japan doesn't look quite as strong as India, but still holding up much better than most of the other countries out there. Remember, Japan, of course, has the backing of Warren Buffett these days, as he owns a significant stake in 5 of the main trading houses over there and has for the last couple of years. So you never know if they're getting a little bit of a, Warren Buffett, seal of approval there to a degree. But whatever it is, Japan is holding up a bit better than others, both of them with that strongly bullish posture at the moment. All these other charts from this primary perspective are struggling here, and many of them have kind of the same feel about them where they attempted to get up and over the 30-day moving average, but it just wasn't in the cards, and they struggled to do that very thing. So you can see that China was down 2.85%, so that kind of confirms my hunch of what I mentioned a moment ago when we were looking at EEM. China appears to be the worst of all of these charts we're looking at on this particular set of 12 grids right here. And remember, China is a hugely important market. From an economic perspective, they're basically on par with the United States as the world's 2 superpowers. From a stock market perspective, maybe they don't carry quite as much heft as the U.S. does. But point that I'm trying to make is that's a big day for China, and not in a good way. It's a big day in a bad way to the downside, nearly a 3% down day. Remember, we haven't had a 3% down day in the United States for quite some time. And if we did, I think people would be pulling their hair out here. And that just happened to China here today. So China really struggled, bouncing down and away from their falling 30-day moving average. Germany has been struggling. In fact, Germany hit a multi-month low here today. I think my buddy Common Sense Investing there on Twitter has been kind of tweeting about Germany a bit over time, and perhaps about Brazil as well. Both of those are either at or near their 3-month lows at this point. So things are breaking down across the globe right now. Germany and Brazil both have sold off so aggressively that they both now have these oversold cluster signals. So maybe we're due for a little bit of a short-term bounce towards the moving average again, but as I mentioned before, it doesn't necessarily mean that's trend changing. It could very well just mean it needs to blow off the steam to the upside a little bit and then roll over once again as we head into the fall and the winter. By the way, France does join Germany and Brazil with oversold cluster signals here today, and also basically at its 3-month low here at the moment. So those kind of seem to be the areas that, from an intermediate perspective, are the most out of favor. Some of these other markets, like South Korea, it's bouncing down and away from its falling moving average, but it's not quite to the lows of where it was here back in the middle of August. Let's take a look at some of the secondary markets now from a global perspective, and that would be chart 5G for those of you following along at home with your chart package that we offer all of our premium members at Market Scholars. So as we look at this, not a lot of difference here. I think probably the one that stands out to all of us is what's going on there in Turkey. And Turkey's definitely been on my radar. I wanted to make a Thanksgiving joke there, but I think I'll wait a couple more months on that. But in all seriousness, Turkey has been on my radar here more recently because my top-down trend trading class has been in a mode here recently where not only are we looking at trend trades from individual stocks, but occasionally we also look at trend trades within ETFs, and Turkey has been one of those ETFs that has been on my radar from a trend trading perspective, and you can see why. I mean, that chart looks absolutely delightful to the upside. When it ends, anybody's guess, but right now it looks like a runaway freight train to the upside there in the country of Turkey. Unfortunately, for all of these other secondary markets, things don't look nearly as bright. I would say that Argentina looks okay down below here, but even there you're back below the falling 30-day moving average once again. But at least here you're closer to the highs of the 3-month range than the lows. With most of these other charts, it's kind of similar to the major economies that we just looked at a moment ago, where many of them are either at or near their 3-month lows. No surprise that Spain is kind of following in the pathway of Germany and France, also at its 3-month low and also with an oversold cluster signal today. Our neighbors to the south here, Mexico, really struggling here today and really for the last week. That's been a vicious sell-off in 1 week's time for Mexico. Holy mackerel. That thing touched a new 3-month low today, but also has an oversold cluster signal. You can see that the Netherlands, so my ancestral home, for those of you that are wondering where that last name of Van Zee comes from, it means of the sea or from the sea, for those of you that know your Dutch over in the Netherlands. But they could use a little boost here these days as they're struggling just like Spain and France and the Netherlands are. France and Germany are, but the Netherlands are down for their 5th day in a row here and have an oversold cluster signal today at a 3-month low as well. And then you could also make the same case for Saudi Arabia. Now, if there's any of these that it's strange, I'd probably say it's Saudi Arabia. Had you asked me before looking at this chart, I would not have said that they were one of the countries out there hitting 3-month lows, right? We know what's going on with oil prices. They're cruising to the upside. Saudi Arabia is a country that, is obviously deeply rooted in the oil trade, and therefore it's a little surprising to see their country index doing as poorly as it is right now. I did think I heard here maybe a week or two ago that Saudi Aramco was maybe trying to sell more shares and do a secondary offering. So I don't know if that has an impact on the overall Saudi Arabia country index or not. But anyway, point is they're at 3-month lows as well, despite high oil prices, and also have an oversold cluster signal. And then down below, same thing can be said for Taiwan. Taiwan very close to 3-month lows and has an oversold cluster signal here today. So there's a ton of these international markets here that are really struggling. If we think we got it bad in the United States, it's equally, if not more so, difficult in the countries around the globe, at least when we look at it through the dollar lens like we are here as American investors looking at these ETFs themselves. So I guess the good news is it's so bad that it could get somewhat better because with all those oversold cluster signals, they're probably due for some sort of a bounce here. And what would spark that, what the catalyst would likely be some sort of a sell-off day in the U.S. dollar. If the dollar could, go down by like 1% or 2%, that would likely usher in, at least in the short term, a bit of buying in some of these oversold international country ETFs that are out there. So be on the lookout for that possibility, because some of them are so violently oversold, like a Mexico and a Spain. Like those are aggressive moves in just 1 week. They could have somewhat of an aggressive move back up in the short term. Like if Mexico could get back just to the middle of its last week range, that doesn't sound like much on the surface, but that would actually be a pretty aggressive move. That's how far it's fallen in just the very, very short term there. So we'll keep our eye on whether that can get kicked off or not. All right, let's go back now to our kind of traditional approach and look at our sectors here in the United States. So this will be chart 5C for those of you following along at home. And at this moment, we have just 2 charts that are green, and that would be energy, which has been green, and discretionary, which kind of is going back and forth depending on the day. So without a doubt, the energy chart is the only one of these sector ETFs, in my opinion, that has a strong trend. Does that mean that all the rest are heading for disaster? Not necessarily, because of course things change each and every day. But at this exact moment in time, if I were looking at all of these charts next to one another like we are right now, and I said pick out the best looking trend, I think 9 out of 10 of us would select energy in that regard. So that remains kind of the stalwart within the S&P 500 here at the moment. The rest are just kind of trying to vie for second place more than anything. And that's kind of a scary thought, because remember, last year in 2022, that's what we went through for much of the year as well, where it was basically energy and everybody else. Like, there was a major gap between the best performing sector and the number 2 sector, right? It was energy at the top, and then like a country mile lower was all of the remaining sectors below it. So I hope we don't get into that mode again, because last year was not a very strong year for the market in general. We'll see. So you can see here, discretionary was up today, likely due to that big move out of Amazon that I had mentioned before. So discretionary was up 0.28% to kind of help stabilize their chart with that green background. Energy was actually down a touch today, but because they had been up basically every day for a week and a half, I mean, look at that. It was 1, 2, 3, 4, 5, 6, 7, 8 days in a row, and those are trading days. And remember, we had a holiday in there with Labor Day, so we really basically were up every trading day for 2 weeks in a row right there. Finally had a down day today, and it was basically a yawn, down 0.1%, so not a big deal there at all. It maintains that strongly bullish posture. The intermediate line is well above the 80 level of the upper reversal zone at 89, so it's got plenty of flexibility up there. Even if it does have a day or two of selling, chances are you're going to stay with that strongly bullish posture there. Whereas with discretionary, it's probably a little bit more hit and miss at 61. Remember, if that starts falling, then automatically it would go back to a bearish posture. So anyway, we'll keep our eye on it. But in terms of who today's biggest winners are, no surprise, it was utilities. Remember, that was my guess without knowing otherwise when we were looking at the heat map, and now I can confirm with my own eyes that was the case. So utilities were up 1.31% today, and then real estate was right next to them, up 0.82% today. But unlike discretionary, where there's still some semblance of strength from an intermediate perspective, these were basically just dead cat bounces, right, out of utilities and REITs. So we think about them differently. They've just been blasted so badly recently that they were due for some sort of a bounce. So we got a little bit of that here today. Hard to say how long it lasts, of course. But, that's the type of move that maybe you can start hoping for out of some of those foreign markets after all of those oversold cluster signals like we had here with the utilities lately. Maybe you do start getting some of those foreign markets to snap back as well. In terms of who the worst performer was today, again, my hunch proved to be true in this case as well. No surprise, that was not a very difficult quiz that I gave myself there, but it was technology that was today's biggest loser. But when you see Apple have a day like it had today, it's almost a sure thing that technology would be the laggard. So anyway, they were down the most out of all of these sectors here today. But where technology finds itself right now is basically sitting right on its 30-day moving average. So, if they're going to make a stand, this would be a good place for them to do it. And it's going to be interesting to see how the Apple event, the iPhone event here within the next week will play a role in whether technology as a whole can stabilize at these particular levels here. So anyway, all of the charts except for discretionary and energy remain kind of in that pink coloring. And most of them, by the way, have the red 30-day moving averages as well, right? The only one that doesn't is energy. I'm sorry, not energy, but technology. I say that in regards to the ones that are bearish, right? So all these bearish charts with the pink background colors are also associated with pink or red 30-day moving averages except for technology. Technology still has the yellow moving average, so price just barely above that falling moving average at the moment. If you get another day of selling in technology tomorrow, that will likely change. They will join all the rest of those charts with the red moving averages. And then with the two green charts over here, you've got discretionary with a yellow moving average. Price is barely above the falling moving average in that case. And then again, another way to identify that energy is our true leader of this market right now. It's the only chart on the board that has a green moving average, and that is not anything new, right? It's been green since going all the way back here to the first week of July. So it's been an impressive run there for a lot of energy related names. All right, let's now get into our trade application example for the day. I'm going to come over here to chart 3A and just have kind of a quick little 3-month view here. And the stock in question is Advanced Micro Devices, ticker symbol AMD. Of course, these days, one of the most important semiconductor companies out there. But as you can see from this chart, things haven't really gone all that well for AMD compared to, let's say, NVIDIA. AMD has really been stuck in a downtrend since topping out back here in the second week of June, right? Remember, since June, the S&P 500 is up, and since June, the technology sector is up. Again, largely due to NVIDIA and some of those companies. Nonetheless, it just goes to show that, within a specific industry like semiconductors, there are going to be some winners and some losers. And AMD is one of the losers at the moment. Notice up here at the top, their 3-month chart, or label, I should say, is red. And it shows that they are down 14% over that time period. When the S&P 500 is up, you'll notice up above here there's this gold dotted line that will show you the pathway of the S&P 500. So basically the way that you can kind of interpret this is if you had an opportunity to, let's say, put $10,000 into either the S&P 500 or AMD, the stock, exactly 3 months ago, you would be up on your investment on the S&P 500, whereas you would be losing money on your investment on AMD. So I thought that this would be a reasonable candidate for a bearish trade idea. Remember, when I was with you on Tuesday, we had done a bullish trade idea on Halliburton. And then prior to that, I think last week, we did that bearish trade on Starbucks. And by the way, that trade did go to max gain. So any of you that took that short selling trade idea on Starbucks from my presentation last week, you should have hit your max gain yesterday. So it's good to have a few of those bearish trades in the hopper. I like to have a little bit of balance in these market outlook videos if we can help it. And that way we can try to educate you both ways. It's not just one of these videos that will show you how to only buy stocks when the market is strong and we just hope and pray that the market just keeps going up, right? Hopefully you guys know that about David and I by now, that we want you guys to feel just as comfortable on the bearish side of the equation as on the bullish side of the equation. So anyway, AMD I think is a reasonable candidate from a bearish perspective here. You can see that it's had kind of this reversion to the mean bounce back higher, and then it suffered with resistance right around its downtrending 30-day moving average. And so today was that bounce back day to the downside. You'll notice the background of the color of the chart is that light pink because that blue line is falling out of favor once again. You'll also notice that we have a little bit of a bearish near-term divergence signal. Now, it's not a big one, so I don't want to make a huge deal out of this, but it is there nonetheless. So you've got this blue line peaking out here, or topping out on August 30th. You have a follow-up top here that looks like a double top to your naked eye that kind of culminated here with the candle on the 5th of September, so here just a couple of days ago. But if you actually look at it, remember there's this little blue number right here. We don't talk about it a lot, but that number that I'm kind of circling right there will allow you to actually see the reading itself, so that way when it's so close that you can barely tell with your naked eye, you can actually confirm it. So like when I hover here, notice that blue number that I just pointed out a second ago says 87.38, and then right here that number says 87.04. So by the smallest of measures, this second peak was slightly lower than this first peak. And the two candles up above associated with that are this candle right here and this candle right here. So price went up at a time when there was a little bit of wear and tear on the underlying indicator right there. So with the selling in technology today, this seemed to be more of a bearish trade idea. And by the way, like I mentioned on Twitter/X here this morning, kudos to David in his video yesterday. I didn't get a chance to listen to it, but I saw the email that he had sent out where his bearish trade idea was on Skyworks Solutions, and that was one of the worst performing stocks in the entire market today. It was the 5th worst performer in the S&P 500. Rarely do you get that lucky where you do a bearish trade like David did last night, and then the very next day the thing just collapses by 7%. It is one of the worst performers in the market. So great job there to David last night. But anyway, if the selling pressure in technology continues, this will give us one of those bearish trades to kind of help balance out our portfolio there. So what I ended up doing was a bear call spread. So for those of you that are newer to that term, basically what I'm doing is I'm selling, in this case, the October 115 strike, and 115 on the chart is approximately right here, and then I bought the 120 strike. Those are both calls. So that's why it's called a bear call spread. You're selling one call, but you're buying another. The call that you're selling is more expensive than the call that you're buying, and that's what creates the credit up front. So that's why it's also known as a credit spread. So you receive money up front. In this case, it was about a 30% return on risk, and your goal with the trade is to have the stock stay below the strike price that you sold, in this case 115. So it gives you a little bit of leeway. If this stock manages to continue to go lower highs and lower lows like it has for the last 2.5 months, I'll be in good shape. But even if it doesn't, and let's say it goes sideways or it goes up a little bit, right? We've got ourselves a little bit of leeway from 106 up to 115. As long as it doesn't go up by more than $9 or $10 per share, I can still end up winning this trade. So that's what I ended up doing in that case. And of course, I sent that out via Telegram earlier today for our premium members. Make sure you're taking advantage of that. But that was kind of the idea here today. We had a rare day where the technology stocks really turned tail to the downside, and I wanted to kind of test that theory a little bit with a trade application example here tonight. So we'll see how that goes. I appreciate you tuning in. Tonight's a big night. It's NFL kickoff, so I'm a Rams fan, as many of you know, but very much looking forward to hopefully a shootout between the Chiefs and the Lions here this evening. So an exciting time of year as we go into NFL opening weekend. So I know some of you are excited about that as well. So enjoy the game tonight. Enjoy the games over the weekend as well. David should be back with you with his video over the weekend, and then I'll see all of you on Tuesday of next week. Remember, if you got value out of tonight's video, make sure you click like for me there on Twitter, and I'll look forward to joining back forces with our premium members on Monday during my 2 classes there as well. So until next time, I want to wish you all the best of success with your trades and your investments. Goodbye for now.